right, ladies and gentlemen, welcome back to the Passive Cash Flow Podcast. I'm your host, Aaron Fragnito. We have an exciting guest here today. We have David McGuire, who is a tax specialist, and he works with McGuire Sponsel. And, well, I guess it's actually one of the owners and partners of McGuire Sponsel. And David, I want to have you on the show because you are a tax whiz. How are we doing today?
I'm doing well. Thank you for having me.
Absolutely, my friend. Absolutely. I must say, I think you have a excellent brand out there. I've been looking into, the content you have online is very in depth and very professional. You run a great company there, and I've enjoyed working with your team as well, getting this set up. So glad to have you on the show here. There's so many things changing with the tax scene these days, the new administration in. So we're going to talk about, the cost segregation, but also kind of the updates and what we're seeing with the new administration and so on. But before we get into all that, let me start with a couple softballs here. All right. And we can kind of take it from there. How's that sound?
That works for me. We love the softball questions. Those are the easy ones.
Absolutely. Absolutely. All right. So first of all, why do you think real estate developers, particularly those investing in multifamily, which a lot of our listeners do, why should they pay attention to the cost segregation?
Well, I think this podcast is called Passive Cash Flow, or that.
That's right.
Cash flow. Cash flow.
That's right. Yeah, Passive Cash Flow Podcast.
Well, and that's where cost segregation comes into play. It's a cash flow tool. Now, what we're doing is kind of taking a step back, because I'm not sure how many of your listeners know exactly what cost seg studies are, but it's when we're talking about residential real estate. Most people know you go out and you buy a piece of residential real estate and you depreciate that over 27 and a half years. You separate out the land and you get a little bit of a depreciation deduction every year. Mm-hmm. You also know, most of your investors know this, they go out and they buy a piece of equipment for their business. They get to write it off quicker, 5 years, maybe take 179 on it, maybe bonus it out, something else. Well, what the IRS says is parts of your building are more like that piece of equipment you just bought than they are the building. So the idea of a cost segregation study is to pull those out, which then creates a short-term reduction in your taxable income, because you're pushing those depreciation deductions out of that 27 and a half into the current year, which then creates cash flow. Now, some people go, that's timing difference. I'm getting those deductions anyways. Most of the people investing in real estate know the value of timing differences. They know, hey, you can get me some cash today. I can reinvest in something else. I can pay down debt. I can pay off a loan that I took out. There's a lot of things you can do with it once you know that you have that cash in your pocket.
Absolutely. Well, the lazy 1031, for example, I just did a masterclass on that, a passive investor masterclass, and it was very popular. A lot of people are interested in that. It's interesting, you basically sell an asset, you have a liquidity event, you have a taxable income, capital gains tax, and then you buy another asset in the same calendar year, and you do a cost segregation study on that new asset. You essentially use the bonus depreciation from the new asset to write off the capital gains on the past asset. As long as you do it the same calendar year, there's no need to follow the 1031 rule book or use an intermediary, and you can essentially do a lazy 1031, which is a buzzword us millennials say. You wouldn't understand it, Dave. You wouldn't.
Well, the nice thing about that play too is you're not constantly pushing the can down the road. The issue with the 1031s is eventually tax man comes due. Now, can you push it forward until we're all dead and gone and push it to the next year? Well, maybe you can do something like that, but eventually it's going to come due. And the nice thing about what you're saying is you're recognizing some of that gain. You're just using depreciation and other methods to offset it. Exactly. Especially when we've got bonus depreciation.
At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth. So find out if you qualify at peoplescapitalgroup.com. Yeah. Well, you could also swap till you drop, which is what a lot of high net worth and multimillionaires and billionaires do. which of course is doing a 1031 and continuing to 1031 and 1031, and essentially then you die and eliminate your tax bill as long as your estate is set up properly. But what's not as attractive with that is you never really get to touch the profit. You're just consistently rolling it, everything, not only the profit, but your entire investment, equity in the property. Now, you could pull out some money on a 1031 and pay your taxes and pocket some cash, but which people tend to do. But yeah, I mean, the swap till you drop is tough because you never really get to touch that money, and it's just building your wealth and your wealth. Now you can cash flow on the assets. There's other you could refinance the buildings, right, and you access the equity that way, tax deferred. But of course, you got your there's another buzz term, swap till you drop. You got your lazy 1031. Man, oh
Mm-hmm.
man, just so many.
Well, that's it's gets to the point where it's like dealing with my kids in text messaging, and I gotta look up what people mean by the definitions because it all changes. Swap to you drop lazy 1031. I go, man, I gotta check this just like when my kids
Yeah.
text me BRB, and I go, what does that mean? But
Hmm.
then again, I might be getting old. That goes to the age more than anything else. But
Yeah. Yeah.
um,
Hmm.
well, and it is interesting, Aaron, because you can combine all these strategies together depending on what it
Hmm.
is. So if you're
Sure.
in a swap till you drop situation, often you're increasing the basis in the property each time. So
Yeah.
you can still potentially do a cost seg study when you do that swap. And
Hmm.
then even though the 1031 rules changed under the TCJA back, was that now? That's 8 years ago now, forgetting how
Hmm.
long ago it was. But you can still include some personal property in that transaction as long as it's 15% or less. And it would be traditionally transferred with the property. You can transfer it, which means it doesn't affect the 1031 basis. So often you could combine the cost seg study with the 1031
Yeah.
and bring it all together. So depending on what's going on, whether it be 1031 exchanges, people investing in opportunity zones, everything, this strategy can come into play in all those areas and really almost supercharge the benefits from it.
That's interesting. Yeah, that's a good point. Yeah, I mean that's the amazing tax benefits of real estate. That's why 60% of billionaires' wealth is held in real estate because there's huge tax benefits. And all right, let me give you another softball here. It's going to be a little faster, but it's still a softball. How does cost seg impact cash flow and overall tax liability for property owners? How's that for softball?
Mm-hmm. Well, and so I kind of mentioned this in
Yeah.
the introduction. The
Mhm.
idea is simply that we're moving deductions around. So I know if you meet with a lot of financial planners, I back when I was a standard employee and I would get my tax return at the end of the year. It changes once you're a business owner, and all the people listening know this. But back when I was an employee, I go out and I fill out my tax return at the end of the year, and it was I would think I was doing great because I get this big tax refund. I go, man, this is great. I'm getting $5,000 back from the IRS when I file my tax return.
Mm-hmm.
You meet with any financial planner and they go, that's not good. That
Mm-hmm.
just means the IRS held on to your money all year.
Yeah. Yeah.
Well, as I mentioned earlier, if we can accelerate depreciation deductions, push them into the current year and get them out of that 27 and a half year, we're
Mm-hmm.
doing the same thing, except we're doing it over a difference between 1 year and 27 and a half, not 1 year of timing. So
Mm-hmm.
what we're doing is we're taking that deduction and we're moving it forward. Now, it does require some things. Obviously, it requires that you have a tax liability.
Mm-hmm.
Now, that's one thing with real estate, especially when we start talking about the Northeast and places where the property values are high.
Mm-hmm.
Sometimes you're holding for the growth of it versus you're holding for that cash flow. So you have to have that tax liability. If you don't have a tax liability, shouldn't be paying somebody like me to come in and do a cost seg study. It's a waste of your money.
Right.
But if we can do it, we can create this cash flow, which then you can then be using to reinvest in the property. You can be doing a lot of other things with it
Mm-hmm.
that can then help grow your business. Now,
Mm-hmm.
uh, I've been doing this a long time. When I started doing it, I had hair on the top of my head.
Mm.
I was much thinner. I was didn't have as many gray hairs. Of course, well, I say that I actually think I have less gray hairs now, but that's just because all the hair fell out. But um, I used to hear all the time that this was just a timing difference. And people would say, "Huh, do I care about it? It was a timing difference." And so we used to sit down with people and we'd go through and go, okay, here's what a gallon of milk cost 30 years ago. Here's
Mm-hmm.
what a dozen eggs cost 20 years ago. Here's what a gallon of gas cost 10 years ago.
Sure.
We haven't had to do that in the last few years because people have seen how much a timing difference can affect their business. I
Yeah.
don't know about your clients. I know my clients specifically. If I come up to them and say, look, I could have saved you $1 million 2 years ago, or I
Hmm.
get you $1 million today, they're
Hmm.
all going to go, well, wait, I needed it 2 years ago. So I
Hmm.
could have reinvested it in something that would have grown because you've seen
Yeah.
how the economy changes. And that's what we're talking about. It's talking about that timing difference that we can create
Hmm.
over time to make it worthwhile.
Hmm. That's great. That's interesting. Okay. All right. Very good. And so what are some like the common mistakes that you see real estate investors make when they're with their tax strategy in general?
A lot of it, to be honest with you, Aaron, it's not thinking it through.
Hmm.
So how we mentioned earlier this 1031 issue. So if you're doing 1031s, it's great when it matches up with your
Hmm.
business. But if you're sitting there going, okay, I'm doing this 1031, but maybe I want to invest in something else long term.
Hmm.
Well, pushing the gains down the road always the best thing. Or have somebody call me up and say, hey, we did this cost seg study, and so I'm a partner in a consulting firm. So
Hmm.
if I go out and I buy myself a rental apartment, let's say I
Hmm.
buy a 2 unit building.
Hmm.
I'm from New Jersey, but I live in Indiana now, so I buy it in Westfield, Indiana. Yes,
Sure.
Westfield. There's a Westfield in Indiana and one in New Jersey, so
Oh,
don't get
nice.
confused. But
Okay.
I buy one in Westfield, Indiana, and I go out and I get a cost seg study done on it. Let's say I buy it for $1 million, and the cost seg provider accelerates $150,000 worth of deductions into the current year.
Okay.
Well, that's all well and good, except I'm a partner in a consulting business. I'm not a real estate professional.
Right.
So
Right.
now I've created all these deductions in an entity that's passive to me.
Hmm.
So I might not be able to use it against my primary income source. So understanding where your primary income source is critical. Thinking through what does it look like over time with these? Am I planning on selling it?
Hmm.
We had a client in actually, well, it's tax season right now. So it was last year, and now we're in tax, or it was 2023, and now we're in tax season 2024. They bought the building in 2023. Their plan was to sell it right away, but they don't want to do a 1031 exchange.
Right.
We did a cost seg study on it, not knowing that they were planning on selling it. We got them $200,000 worth of deductions. That's great.
Yeah. Yeah.
They 30% tax rate, they save 60 grand. They're turning
Hmm.
around and selling it right away. Well, they have this dreaded thing called 1245 recapture, which basically means
Hmm.
that recapture penalty is going to be at ordinary income. Now, it
Hmm.
doesn't cost them anything. They're only
Hmm.
going to repay at that amount of that deduction. So, but basically, all they did is they created a 1 year timing difference, not a
Hmm.
multi-year timing difference. So,
Yeah. Yeah.
what I tell people all the time when we're talking about cost seg, when we're talking about tax issues, it all needs to be thought of holistically. Is what's
Hmm.
going on that you can change?
Yeah.
Um, you're in New Jersey. New Jersey right now, you can drive around New Jersey. You see a lot of solar panels being put on buildings and solar
Uh-huh.
investment and other things.
Hmm.
If I'm a real estate company, I'm in a year where I'm doing a lot of investment in solar or other things. I might not want to do much cost seg that year because I've got these huge tax credits coming through from my solar investments.
Hmm.
Now, the nice thing about cost seg studies is that it doesn't go away. I can have an investment in that. I can take the tax credits on the solar. That offsets my tax liability this year. 2 years later, I have a big tax liability. I can do what's called a change in accounting method and go back and do the cost seg study on the property I acquired 2 years earlier and
Right.
pull forward the depreciation deduction. So,
Hmm.
whenever we're talking about timing issues and things like that, it's important to match up the deductions with the time
Yeah.
I'm using it. And so,
Yeah.
those can be critical. And so, that was a long way of saying the answer to your question is what's the mistake people make when it comes
Yeah.
to tax? And it's not thinking everything through and being almost 2 steps ahead. And
Yeah.
it's
Yeah.
it's always reactive. Be
Yeah.
proactive on it.
At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth, so find out if you qualify at peoplescapitalgroup.com.
Right. And there's two important points you brought up there is that you have two different buckets, essentially, as I explained it. You have your active income and active tax write-offs, and then you have your passive income and passive tax write-offs. So people do have to understand when you're invested as a limited partner, an LP, in a real estate syndication, for example, as our investors generally participate, those are passive tax write-offs they're getting on a property. And most people experience active income. Now, as you get to higher net worth individuals and family offices, a lot of their income is actually passive income because they
Mhm.
primarily make their money by investing passively in opportunities and prefer not to be active. Where then with more of the accredited investors, you see their income being maybe from a business they operate or active real estate they own and operate or things like that. So um, that's why when we buy a property, we talk to our investors and we say, hey, do you need a large passive tax write-off right now? Do and a lot of them will say, no, we don't, depending on the investors participating in the opportunity. Especially as our investor base years ago was, some accredited and some non-accredited investors who really didn't need a big passive tax write-off. And the buildings were a little smaller, really like 3 or 4 million, so it didn't always make sense to do it. But basically, in that case, we actually didn't get a cost seg done. Now, fast forward to today, we have more family offices investing with us, higher net worth individuals, and a lot of those investors have invested with us multiple times. And some of those buildings we've sold, so they actually are now creating passive tax burdens. So it is good to invest in these buildings, and then we do the cost seg, and we get the big passive tax write-off. We accelerate that bonus depreciation. And so, you want to understand who your investors' needs are and if they can even really utilize this passive tax write-off. And then the other point you made was that, yeah, we sell the buildings out over 5 years. So, you have tax depreciation recapture. So, essentially you do have to kind of give back that tax depreciation when you sell. But if you have it for 5 years, that makes a big difference. If you have it for 1 year, you're not really kicking the can down the road that much further, So, you want to gauge, how long you own the asset there. So,
Well, that's when your lazy 1031 or your standard 1031 can come into play too. You own it
yeah.
for 5 years, then you can start looking at doing it again or compounding the benefit, so to say.
Okay. Yeah, absolutely. Now let's jump into what we see going on right now. Okay, we have a new sheriff in town, and like him or hate him, things are changing, and I do think we're seeing a more pro-business environment. But we also have things like tariffs, and there's probably going to be a little bit of short-term pain for long-term gain, in my opinion. And so, what do you think we're seeing with market conditions right now? We have interest rates that are not really rising. I do think they're going to start coming down, but we have higher interest rates. We have potentially some economic slowdowns with tariffs and things like that. How do you think that could impact the benefits of the cost seg and bonus depreciation for apartment building owners?
Well, I'm going to start this by saying I'm not an economist, so anything I say, take with a grain of salt.
Sure.
I I pretend to be one sometimes. I read a lot, but
Mhm.
I'm definitely not an economist. So that said, where do we get lumber from?
Mhm.
We're talking about apartment complex. Where do we get lumber from? We get lumber from Canada. A lot of it comes in there. So if we see tariffs, that's going to increase the cost of uh, construction. We see a pushback on in different areas. We could see cost of building going up. You see, if interest rates start dropping, that could increase the value of assets because now it's going to be cheaper to borrow. We don't know where all that is. What we do know is that, as you said, there's a new sheriff in town, so things are going to change, and there might be some short-term pain for long-term gain.
Mhm.
So, whenever we see a situation like that, it's times where you want options. So,
Mhm.
how do you create options? One of the ways is having more cash in your pocket. If I've got
Mhm.
more cash as an investor in my back pocket, I can use that to go make investments if I see ebbs and swings. I can play the economy a little bit more. You look, if I'm sitting there and I go, man, I see it's always buy the dip.
Mhm.
Well, if I buy the dip, that means I have to have money to buy the dip. So
Yeah.
when we're talking about creating cash flow,
Mhm.
that's where it really creates huge opportunities. Now, that's just cost seg in general. Now, there's
Mhm.
tax law in general. So we mentioned bonus depreciation, 1031. A lot of the stuff we're dealing with today in terms of tax policy is based on the Tax Cuts and Jobs Act of 2017.
Right.
So a lot of those things were expiring. So bonus depreciation. So for those who don't study tax law all the time, bonus depreciation, that's that immediate ability to write off certain assets. That was put in under the TCJA, and it was a temporary provision, basically 5 years of 100%. And then it started leveraging down at 20% per year. So we're in 2025. Based on the statute right now, you buy an asset in 2025. If it's eligible for bonus, you get to write 40% of it off and then depreciate the rest. The current plan by the new administration is to extend bonus depreciation back at 100% through whatever their tax bill is. Now, typically, we see that prospectively from the time the tax bill is signed. Now, people that don't necessarily know what day we're recording this, but I will say it's just after the president spoke to the joint session of Congress earlier this week.
Right.
In that speech, he did say that he wants to see bonus depreciation at 100% retroactively put in place as of January 20th of 2025, which would be, I believe that's inauguration day, if I'm not mistaken. So that means if you buy any asset moving forward in 2025, the things that we say are bonus eligible, if that's what actually gets in the final bill, will be at 100%. Can we guarantee that? No, we can't guarantee anything till Congress does their job and the Senate does their job and they actually pass something. It's not just a flick of the pen. This happens. It has to go through. Although some things are happening that way right now, tax bills are not going to be one of them. Tax bills are still going to have to go through the standard legislative process.
Yeah. But Republicans do hold the House and the Senate, although by a thin margin. But I think something like that, that's going to really help the real estate environment. I think it's going to help real estate investors. It's going to help tax companies like yourself there and just accelerate the economy. I mean, that's how much easier is going to be, right, to sell the service of cost segregation when you can take 100% bonus depreciation over 40%, right? It's definitely got to be detrimental to tax professionals. And for someone like me who owns the real estate, I mean, there's no reason why I don't go out and say, because now it's like, oh, we've seen, you almost like the 100% bonus depreciation, we took it for granted in a way, right? And then we had an administration in there that wasn't necessarily pro-business, in my opinion, and we saw, that taken away from us, that bonus depreciation, and it was kind of watered down. So now, I think what we see now as a property owner, it's like we take it less for granted, so if they bump it back up to 100% bonus depreciation, we know there's a good chance that might not be there forever. So I'm going to run out and get myself some cost segs because I don't know how long we're going to be able to get 100% bonus depreciation on our properties. So it's good for you. It's good for me. It's good for everyone.
Yeah, my expectations, we'll probably see it for a 5-year extension, similar to what we saw last time. The reason being is it's that whole legislative hassle that we have to deal with, that anything we see right now is because of that slim majority in the House and Senate. We're going to be dealing with the Byrd rule, which, not to get policy wonky on everybody that's sitting there, but that means that it would have to not affect the deficit on a negative basis after the 10-year window. That's simplified. Any economist or government professional is going to be sitting there going, he got some of those words wrong. But in simpler terms, it can't affect it over 5 years. So bonus depreciation is pretty much free if they extend it for 5 years, because by the time you get to that end of that 10-year window, it's phased out and you're seeing the receipts go up, which is why typically you see these kind of things have these temporary extensions. So my expectation is we'll probably get a 5-year extension. So we're in 2025, probably until about 2030, which means that investment window, as you said, it's going to be a great time to be investing in those assets over that 5-year period.
At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth. So find out if you qualify at peoplescapitalgroup.com.
Yeah. Yeah, exactly. Exactly. So basically, people go out and get your real estate now, get your cost segregation studies done once this law goes back, because that's a big difference. If you do a cost seg today with the current law, you only are allowed to take 40% of that bonus depreciation. Now, the current administration is talking about bumping that back up to 100%. That's a huge difference, right? It's over 100 times, 2x on the tax depreciation, right? So that's interesting stuff. All right. Very good, David. Very good. Let me give you a couple of curveballs here. Okay. Um, so basically, with the tax laws changing, so here, of course, in the U.S. we have a new administration every 4 years, generally, sometimes 8, but in this case, we know, there'll definitely be a new president in 4 years from now, and we'll see, of course, who comes in. But with the kind of constantly changing tax laws, how do you remain like effective in the long term? And how does like kind of the broader economy play a role in people's general tax decisions?
Well, there's a couple things there, Aaron. First off, the typically, if we look at, for example, under the Biden administration, they didn't really change tax laws as it relates to this. That we're still dealing off of the TCJ and the leveraging down. So we can plan on some of this being permanent. Now, could you potentially see tax rates go up under a new administration if it switches in a few years? Possibly. That was obviously the plan if Harris had been elected. But keep in mind, a lot of the things like bonus depreciation, those extensions are often bipartisan. There was actually a bipartisan bill that was put out about this time last year, and then it got delayed, which is the reason we didn't see it. It was an extension of another area of the tax code called 174. We don't want to get into that today. That deals with research. And 163J, which is that interest limitation that real estate people deal with, and then also bonus depreciation. And all of them would have actually gotten a 5-year extension. And that was pushed through as a bipartisan bill. So some of these things are bipartisan. But the main thing, in answer to your question, is we don't know. I don't know what tomorrow brings. I don't know what next year brings. I don't know what the economy looks like. So the key thing is when I have the ability to take deductions, I want to take. So let's say, for example, I'm right now working on 2024 tax returns. If I'm sitting there on a 2024 tax return and I've got a tax liability and I've got deductions I can push into 2024, I don't want to hold on to those till 2025 because let's say there's an economic collapse sometime halfway through 2025. I hope not. I don't want to plan on it.
Right.
But if there is, those deductions might not have the same value to me if I don't have the same tax liability. So the key thing is whenever I have it, to pull it into that year and take as much as I can in the years I can utilize it, because that's going to save me money or create that ability to do something in the long term.
Absolutely. Yeah. One in the hand is better than two in the bush, right? Absolutely. Yeah.
There's a reason that we have those old sayings, but
yeah, absolutely. All right, David. Very good. Very good. Well, you're clearly a tax professional there, very knowledgeable of your space. And that's why I want to have you on the show here of the Passive Cash Flow podcast. And how can people reach out to you and connect with you to learn more?
Yeah. So one of the easiest ways is if you go to our website, McGuireSponsel.com, all my contact information is up there, as well as different people that work there. Now, if you go on our website, obviously you're based in the Northeast. I'm based in Indiana. We have offices all over the country and we do work all over the country. So feel free to reach out if you've got questions. If you reach out to me, my phone number is listed on my website. It's not hey, call this number and you get an office manager or something else that screens my call. No, you're going to get my direct line. And if you send me an email, I'm going to respond to it. And in my email signature is my cell phone number. What we want is we want people to have access to the people that know what they're talking about as it relates to some of these things. So too many of these tax things and business things have become this black box that people try to protect. My opinion is reach out. Let's talk about it. Talk about your situation. Figure out if we can help. If we can, great. If we can't, that's bad for me. Sometimes people say I'm a bad person because I talk people out of selling me, doing stuff through me as much as I talk them into it, because I want to make sure when somebody does work with McGuire Sponsel that they they actually see a benefit from it and they feel good at the end of the day.
Absolutely. And just do me a favor and spell that website for our listeners there so they go to the right place. Yeah.
So it's McGuire Sponsel. McGuire is my last name. So McGuire, and Sponsel is SPONSEL.com. So McGuire Sponsel. And like I said, if you spell it wrong and put it in Google, it's probably still going to come up with us, even if you don't put in the whole website. So if you just search for McGuire Sponsel, you're probably going to find it pretty quickly.
Okay. Excellent. All right. And you also give tips on hair design, right? Is that one of your specialties also?
I used to, but I stopped doing that a few years ago, right around the time COVID, all that fell out of my head. So, but that said, I do have 6 daughters. So trust me, there's enough hair stuff going on in my house on a regular basis. I just don't get to, I don't get to be the guinea pig anymore.
6 daughters. Wow. That's statistically speaking, man, not a, all right. That's tough. Well, that's a lot. All right. Beautiful. You sound like a blessed man there, David. Excellent stuff. Thank you so much for coming on the show. And to our listeners, if you're enjoying what you're hearing here, if you feel like you get value out of the Passive Cash Flow podcast, then share this with a friend, send it to a colleague, another property owner, a business owner, a hardworking individual who's trying to pay less taxes and earn more money and doesn't like giving their money to the IRS, or wants to start building wealth in real estate, making their money work for them. Also subscribe. We are on YouTube. We are on all the major podcast platforms there, so you can subscribe to our show. We come out with a new episode every single month, and we focus on how you can build and preserve your wealth, usually in real estate. We have different professionals on as well that specialize in different asset classes also. So David here joined as a tax specialist. Hopefully you learned about the cost segregation study and tax strategy. And you can reach McGuire and Sponsel there as well. They're a great firm that can really help you out with all different tax questions. So thank you so much, David, for coming on the show. I really appreciate your time, my friend.
I appreciate it. Thanks for having me.
Thanks a lot. Have a good day.